Folks, I'm not going to sugarcoat this. It is not good news. Yet another CEO of a major U.S. corporation has reported that the consumer is slowing down and their pocketbook can no longer afford the price increases that we're all seeing. This time it's the CEO of Starbucks, Laxman Narasimhan, and his team sharing what's going on at Starbucks, what they're seeing from the consumer. And remember, the consumer represents 70% of the entire spending in the United States. And so if the consumer slows down, we all have to be worried about, is a recession coming? And obviously, we're all hoping for a soft landing by the Federal Reserve as they fight to bring inflation down, really to get that last mile of inflation. So let's jump in. Let's see what Starbucks is seeing with the consumer. And then importantly, at the end, I'm going to share, based on this information, what I think we all should be doing. Okay, so first off, it's not just me that read this earnings report and said, ugh, that's another sign of not good news. In this case, for Starbucks, their stock was down over 10% in a single day. You can see that in the stock chart by CNBC here. And let's jump into an article by CNN that explores this. And the title is Starbucks Just Had a Disappointing Quarter. Here's how they plan to turn things around. I'm not going to focus too much on their turnaround efforts, more on what they're seeing. And the first thing they saw was same-store sales in the United States fell 3%, which is a sharp reversal from the previous year. And in China, they're seeing an even bigger slowdown, 11% in China. But stick with me, 3% sales growth might not, a negative 3%, might not seem so bad. But let's look at how many transactions they're down. That's coming here in a minute. But first, let's hear what the CEO has to say. Narasimhan says, we face a challenging operating environment. Headwinds discussed in the previous quarter have continued in a number of key markets. We continue to feel the impact of a more cautious consumer, particularly with our occasional consumer, and a deteriorating economic outlook has weighed on customer traffic and impact has been felt broadly across the industry. Okay, so what he's saying here is the consumer slowing down and the forecast for the economy, the U.S. economy, is having an impact on how much we're all willing to spend on $5, $7, $10 coffee drinks. Okay, let's switch over to the New York Times, where they report same-store sales at Starbucks are pushing down revenue 1.8%. Again, we want to focus on the consumer, the 3% same-store sales slow down, their overall revenue being down 1.8%. A lot of folks will think that doesn't seem too bad, but stick with me. We're going to get more into the consumer here in just a little bit. So this article by Julie Cresswell of New York Times, Starbucks on Tuesday reported their global revenues fell while their net earnings slid 15%. That's a big, big move, given that it was just 1.8% of their revenue. So what's going on here? Well, in comments to Wall Street analysts after the market closed, the CEO goes on to say, if I look at the headwinds we see in the market, particularly with the consumer and the pressures they face, they were sharper and more accelerated than what we expected. So the consumer did worse than what the CEO was expecting. So that is not good news for the U.S. consumer. Okay, now let's again, how many fewer people are coming into Starbucks? How many fewer transactions are they doing? This number is going to be startling. And this I found in Restaurant Business. Their article, Starbucks Sales and Traffic Took a Big Hit Last Quarter. Here they report the U.S. same-store sales declined 3%, but it was entirely driven by a 7% decline in transactions. And a 7% decline in transactions is a big deal. That means 1 out of 14 items that were being ordered before, or you could look at it another way, maybe 1 out of 14 customers that were coming into Starbucks did not come in this most recent quarter. So that's a pretty big drop. It's not 1 out of 10, it's not 10%, but it's still a big drop. It's 1 out of 14 approximately is the way to look at that. And for Starbucks, this was the first negative performance since 2020, when they were forced by government regulations because of COVID to shut down many of their stores. And before that, we'd have to go back over a decade to before 2014 to find, or really 2010, because it's a decade before 2020, to find a negative quarter over quarter sales for Starbucks. So this is a big deal. So now I'm going to start putting this in perspective versus the entire US and what we're seeing with the consumer, and then share my thoughts on what this means for all of us. First, from an inflation standpoint, it's really hit our food costs the most. And unfortunately, the convenience food, the fast food, we all know it's not healthy for us, but we all eat it occasionally when, we find ourselves in a bind. And the fast food restaurants, the major chains, have really been increasing their prices at a rate faster than inflation. This is a great chart by Finance Buzz, fast food price inflation. So from 2014 to 2024, actual inflation here at the bottom, you can see that is 31%. Starbucks and Subway are two of the U.S. chains that have increased their prices the least. Still greater than inflation, almost 40% instead of 31%. But still, if you look at this chart, quite a bit less than Wendy's, Jimmy John's, Chipotle's, Taco Bell, Popeye, and unfortunately McDonald's is at the highest of that list. McDonald's increased their price over 100% in the last decade. Starbucks is about 40%. Now, Starbucks is a high profit margin business, and Starbucks needs fewer employees to provide their services. And it's easier to automate some of the tasks at a Starbucks than it would be the complex tasks at a McDonald's and assembling all these different hamburgers and chicken burgers and what have you. So Starbucks, who's still seeing 1 out of 14 of their consumers have stopped coming in, their transaction volume has dropped by 7%. Starbucks is one that has raised their rates the least, but still higher than inflation over the last decade. If you're curious, here's from that same article from Finance Buzz, from that same article, here's Starbucks, some of their menu items and how the prices changed 2014 and 2024. A grande coffee mocha went from $4.15 to $4.95. So that's actually less than inflation. But if you want to see a broader look at inflation, Visual Capitalist did this chart based on Finance Buzz's data. And these are might be some of your favorite treats at Starbucks. The cake pop that a lot of kids like has increased almost 100% over the last 10 years. Some of the drinks, you can see the coffee drinks have actually increased at a rate of inflation or slightly less. So the tall mocha frappuccino used to be $3.75. It's now $4.95. So that's a 32% increase, essentially kept up with inflation. But things like bagels, sausage, cheddar, bacon sandwich, their spinach and feta breakfast wrap. These are the types of things that have increased at a rate higher than inflation. And then some of the coffees, the venti caramel, macchiato, I think I said it correctly, increased only 17%. So what does all this mean for us? Well, first, this is not a deep dive into Starbucks in particular. This is not a deep dive into fast food. None of what I'm sharing is financial advice or investment advice. I have no idea whether the price of Starbucks stock is going to go up or not. I will say Starbucks is a very well-run company, and these types of challenges, this is what companies do. This is why the CEOs of these major companies get paid tens of millions of dollars, is to help turn around when there is a challenge like this and to keep the team motivated and focused on the things that move the needle. So this is not investment advice. This is not financial advice. But what I will share is for all of us, for the last decade, buying the dip, for the last 20 years, really since the great financial crisis, buying the dip has been a smart thing to do. The market drops, even like 2022, which was, fairly protracted. It lasted about a year, that correction. But people that bought in were rewarded pretty nicely in a short period of time. And that doesn't always happen. Buying the dip doesn't always work. I liken it to picking up pennies. off of the railroad tracks, or nickels or dollar bills off of railroad tracks. You can do that, and you can do that. You might be able to get away with that for days, hundreds of times, even thousands of times. But if you're not careful, one time you're going to reach out for that nickel or that quarter on the railroad tracks, and you're going to get smacked by that train. So it's a risky strategy, and I think it's a strategy that can lull people in. So if you've been buying the dip, just be careful. What I think the vast majority of us benefit from doing is coming up with a long-term asset allocation. What percent of our portfolio in stocks? What percent of our portfolio in high-quality, short-duration bonds that are going to mature in 1, 2, 3, 5 years? So really focusing on the quality. And then on the stock side, some stock investments that you're committed to the companies or to the indexes to get broad market exposure, and you can withstand those ups and downs. So is a recession coming? I don't need a crystal ball to answer. Yes, of course, a recession is always coming. But what none of us know is whether it's coming in a week, a month, a year, or a decade. And that's the challenge. So you want to have an asset allocation that's right for you. Many of us may have allowed our stock allocation to increase during this period of time where anytime the market's corrected, it's come back fairly quickly, maybe 12 months, but many, many times in under a month, under 3 months. Even COVID, right? A 34% drop, a little over a third in a 1-month period was unprecedented. The stock market had never seen that. Yet we recovered fairly quickly from that. I just want to share, we all know this, but sometimes the market goes down and stays down for a period of time, a year, 2 years, 3 years, or more. There have been lost decades in the stock market where it took a decade to come up, peak to trough, come back up to the previous high. During the dot-com bubble, that took a little over 3 years to recover from, and it took the frothiest index, the NASDAQ, even longer. So come up with a long-term allocation that you can stick with. Yes, there's scary news like this. This is what companies do. They have to continue to do things better, faster, and cheaper. So if you like this video, I think you'll also enjoy this video here where I talk about some of the challenges that boomers are facing. Boomers are in trouble. And if you're not a boomer, many of my viewers are close to the boomer age, and learn from the boomers. What mistakes did they make, and where are we feeling pain? So boomers are in trouble. I'll see you in that video. Thanks for watching this one. Bye-bye.